Hey, good morning traders. This is another implied volatility crush example, this time on Tesla after its earnings. So Tesla had earnings yesterday. The stock is up 3% on here, but you can see the implied volatility for the option expiring on July 22nd. They are above 100. The implied volatility is above 100 as of now. So we are going to be looking at the open here in exactly 18 seconds to see how the implied volatility crush going to affect the options on Tesla, just like we did yesterday on Netflix. So the stock is up 3%. So let's go and see the in the money contract. So let's say 760 and about, how much money are they going to make? So for the weekly call, 765, they are costing $13 and you're making 30%. So this actually is better than Netflix yesterday, because Netflix yesterday in the money contract, they were really losing out big. All right, so here the one that are losing, the implied volatility yesterday on Netflix was 200%. This one was 115, but here's the point: the implied volatility change, right? So it's reducing minus 24% to start the day here, but this time the stock is really up a big time on here. So let's see which contracts are making money. 800 calls, they are barely even. Yeah, they are out of the money by $30. They are barely even, but the implied volatility reduced by a mere 25%. Is not as severe as we saw yesterday on Netflix, but this is just another one of the examples. So this means, for instance, that anybody who bought, let's say, this contract here, the 820, anything above 800, mind you, they were quite expensive, because right now the 820, for instance, they are losing 50% of the value. These are the calls. Yeah, meaning the stock is up, it's gaining $25 extra. But my friend, because your options, not really because they were with that way out of the money, because I mean we know you can make money with out of the money contract, right? But because the implied volatility reduced by 25% thereabout, all of this contract here, look at this, the 880, they are losing 76% of the value. And yeah, so these are the big losers on here, as being victim of the implied volatility crush here this morning on Tesla. So this is what we wanted to show you and capture yet another exhibit of how does implied volatility impact option price. So the 800 calls right now, they are barely even, yeah, minus 6%. But my friend, you had to spend, let's say they're down minus 10%. You had to spend between $400 and $450 for them yesterday. Then this morning is not that jovial at all. So this is why for us the best technique that we use to trade option is to wait after earnings, because then imagine when you are trading right now, if you're taking a trade right now, you are trading it with much lower implied volatility, and you can day trade any one of these contracts and actually make decent money. So that's all we had on here on Tesla implied volatility crush post its earning. Is July 20th earning 2022. We catch you on the next episode. Thank you. Bye bye.